You already know dollar cost averaging, the calm habit of investing a fixed amount on a fixed schedule. But there's a newer twist that some investors use, sometimes called stock cost averaging. Instead of letting the calendar decide when you buy, you let the stock itself decide. Today we compare the two, the classic method and the new one, and see exactly when each truly makes sense. First, a quick refresher on classic dollar cost averaging. You invest the same fixed amount, say $200, on the same day every single month. You do this no matter what the price is doing, completely ignoring the chart. Its great strength is that it is mechanical, emotionless, and almost impossible to mess up. For a broad index fund, this is close to perfect because the whole market almost always grinds higher over time. The calendar buys, you never overthink, and the long-term trend quietly does the work. For most people, on an index, this remains the gold standard. But classic dollar cost averaging does have one real blind spot. It completely ignores what an individual stock is actually doing. Imagine you are averaging into a single company that happens to be in a brutal, relentless downtrend. Pure calendar buying will keep feeding money in month after month all the way down. You would be mechanically catching a falling knife, the exact mistake we warned about earlier. On a single stock with no bottom in sight, blind averaging can simply pour good money after bad. The chart is screaming useful information, and pure dollar cost averaging flatly refuses to listen. That blind spot is exactly what the new method tries to fix. Stock cost averaging means you still buy in pieces, but the stock's own behavior tells you when. Instead of buying on a fixed date, you buy at planned conditions on the chart. You split your planned investment into several tranches, a few separate buys instead of one. Then you release each tranche only when the stock actually confirms it deserves it. For example, you add as the stock builds a higher low or reclaims a key moving average. You are averaging into strength and confirmation, not blindly into the calendar. If the stock keeps falling and never confirms, you simply keep your remaining cash. You never spend your last bullet on a knife that is still falling. Some investors do the reverse, pre-planning buys at specific support levels they genuinely trust. Either way, the stock, and not the calendar, is pulling the trigger. This blends our two worlds, the patience of averaging with the discipline of the chart. It is dollar cost averaging that has finally learned to read chart. So which method should you actually use? It honestly depends on what you are buying. For a broad index fund, stick with classic calendar dollar cost averaging. The whole market does not need your timing, and the simplicity is a feature, not a flaw. But for a single, individual stock, the chart carries real information you should not just ignore. There, averaging in by the stock strength can protect you from feeding a loser. Classic DCA is time-based, hands-off, and perfect for the index. Stock cost averaging is condition-based, more active, and aimed at individual names. One is set and forget, the other is plan and watch. Now the honest caveat, because the new method is definitely not a free lunch. Letting the stock decide requires real skill, discipline, and chart reading that you actually have to practice. It is dangerously easy to fool yourself into calling fear patience, or calling a pure gamble confirmation. Done badly, the clever method can underperform the boring one quite easily. And every extra buy on an individual stock means more decisions and more chances to be wrong. So be brutally honest about whether you are really an index investor or a genuine stock picker. If you're mostly buying the index, the answer is simple. Just keep your calm calendar averaging. You will quietly beat most of the clever people who are busy trying to be clever. The new method is a sharp tool, but only for those who genuinely pick individual stocks. So let us lock the difference in. Classic dollar cost averaging lets the calendar buy, which is perfect for a broad index fund. Stock cost averaging lets the stock's own strength buy, which is useful for individual companies. Time-based versus condition-based. Set and forget versus plan and watch. Match the method to what you are actually buying and never average blindly into a falling knife. For most of us, calm calendar investing into the whole market is still the quiet winner. I will see you in the next one, where we get concrete and build an actual buying method around moving averages.